Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Barbeque Nation, hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashish Kanodia from Ambit Capital. Thank you, and over to you, sir.
Thank you. Good evening, everyone. Thank you for joining us for the 3Q FY22 earnings conference call of Barbeque Nation. From the company, we have Mr. Qayyum Dhanani, Managing Director, Mr. Rahul Agrawal, CEO and Whole-Time Director, and Mr. Amit Betala, Chief Financial Officer. We'll start the conference with opening remarks from the management, post which we will open the floor for question and answers. Thank you, and over to you, Rahul, for opening remarks.
Sorry, that would be Qayyum Dhanani. A very good evening, ladies and gentlemen. I take the pleasure in welcoming you to Q3 FY22 conference call of Barbeque Nation. Post the onset of COVID-19, Q3 was particularly the first quarter with minimum dining operating restrictions. I'm happy and proud to announce that in this quarter, our company has delivered highest ever quarterly sales of rupees 287 crores and highest quarterly EBITDA of INR 70 crores. Our dining segment sales have crossed the sales during the pre-COVID period of Q3 FY20. Our delivery segment has also continue to deliver strong year-on-year growth. Our network expansion plan is on track. We have added 7 restaurants in Q3 and another 3 restaurants in January 2022. We also have a strong under construction pipeline of 13 restaurants. We are confident of achieving our target of opening 20 new stores in FY22. And we'll also strive to close FY22 with 188 restaurants against our previous target of 184 restaurants. We also added 4 new extension kitchens, taking overall extension kitchens count to 12 at the end of the quarter. While we started Q3 with significantly relaxed operating restrictions, towards the fag end of the quarter, most of the markets saw restrictions of operating capacity, weekend curfews and night curfews, of course. The impact has continued in the month of January, which ranged from restrictions like, complete dining shutdown in Delhi, weekend curfews in Bangalore, and night curfews and seating capacity restrictions in most places. While this will impact our performance in Q4 of FY22, we have already witnessed relaxation of some of the restrictions and are hopeful of a strong recovery during the rest of the quarter. With this, I will now hand it over to Rahul to take you through the performance of the business and the company during the quarter. Thank you.
Thank you, Qayyum. Good evening, everyone. I hope you and your loved ones are safe and healthy. While COVID-19 related industry risks are not behind us, we are experiencing diminishing economic impact during subsequent waves. As mentioned by Qayyum, since the onset of COVID-19, Q3 FY22 saw minimum dining operating restrictions. With an improving operating scenario, we are happy and proud to deliver the record quarterly sales and profits at Barbeque Nation. Our operating revenues were 287 crores in Q3 FY22 compared to rupees 195 crores in Q3 FY21, thereby registering a strong growth of 47% over the previous year. The operating revenues in Q3 FY22 were 23% higher than the revenues in pre-COVID comparable period of Q3 FY20. We saw strong recovery in our dining business, surpassing the levels of Q3 FY20. Our dining business grew at 44% versus the previous year. In Q3 FY22, the dining revenues were 108% of the dining revenues in pre-COVID comparable period of Q3 FY20. With dining operating revenues at 240 crores, Q3 FY22 has recorded highest quarterly dine-in sales for us since inception. In addition to the strong performance in our dine-in business, our delivery business has grown at 64% versus the previous year. Despite the strong recovery in the dine-in segment, our delivery business maintained the momentum and is generating incremental revenues of 15 to 20% over the pre-COVID revenues. We have strengthened our effort towards store expansion and opened 7 new restaurants in Q3 and another 3 restaurants in January 2022. Our current restaurant network stands at 177, with another 13 restaurants under construction and an equally strong pipeline of work in progress stores. 90% of our store network had both dine-in and delivery operational for the full quarter. In these restaurants, we have achieved average quarterly sales of around 1.75 crores per restaurant and delivered a strong restaurant operating margins of 21.5%. Our reported EBITDA was 70.2 crores in Q3 FY22 versus 50 crores in Q3 FY21. Without the impact of Ind AS 116, in Q3 FY22, EBITDA was approximately 44 crores and PAT was 18.3 crores with an EBITDA margin of 15.4% and PAT margin of 6.4%. With this, we'll now open the floor for an interactive Q&A session. Thank you.
Can we open for Q&A, sir?
Yes, we're okay.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Prakash Kapadia from Anived Portfolio Managers. Please go ahead.
Yeah, thanks for the opportunity. There are a couple of questions from my end. What trends are we seeing on raw material cost and freight cost, and how are we managing it in the current scenario? Have there been price hikes? If you could give some sense on pricing changes done on a year-to-date basis. Secondly, on delivery sales, we have plans to double it next year. So, what kind of SKUs and price points are going to drive this? And directionally, from this 15-16% of sales, should we expect like a 25% contribution in 2-3 years? And also in delivery sales, if you could comment on average billing size changes, if any, over the last 3-4 quarters, that'll be helpful. Thanks.
Right. Thank you. So on the raw material side, yes, we are seeing unprecedented inflation, especially on the meat prices. Things like prawn, mutton, we are seeing inflation that we're not seeing in the past. And like any other business, we have also taken some price hike. In the quarter, this quarter versus the previous year same quarter, we have approximately 5 to 6% price hike on the overall portfolio level, right? There are some outlets, obviously, we also corrected the price based on what the market feedback is, but on a portfolio level, you would see 5 to 6% price hike. So that's on the raw material side. On the delivery side, we have said in last year FY21 that FY22 would strive to grow our business by 2x, and we have already achieved that target in the first 9 months of this financial year. What we expect is that we have hopefully closed this year at almost 200 crores of delivery sales, which if you look at the pre-COVID period, it was around 28 or 9 crores. So very happy to see the incremental business that we added from delivery in the post-COVID scenario. Going forward, I think every year doubling from this is not possible, and we don't plan to do that. But my expectation is we should deliver pretty much 20-25% growth on the delivery portfolio now. And the way to look at it is what we are very happy about is if you look at our delivery business, despite the way our dining business has recovered, our delivery business has pretty much maintained that momentum. And now my expectation is this business would range between 15 to 20% of the overall top line. Also, the business is very young. We practically started it during COVID time, and we are in the second year of this business. And the way we are seeing the response from customers, the changes that we're making on the product menu, pricing. So very happy that it is going in the right direction. In terms of other parameters, our delivery business is largely driven by box sales, which is barbecue in a box, which is a high APC product. So overall blended APC that we generate is pretty much 1.8 to 2x of the industry, and that helps us to give that superior economics also on the delivery side. But it's still business, work in progress, and we want to build it for long term with a view that the acceptance of consumers for the product is very high. So focus is more on product and profitability and sales. And even though the short-term profitability may be lower, we are okay with that right now.
And on the BBQ box, has there been increase in prices as compared to last quarter?
No, we have not increased the prices on BBQ box.
So on individual items or single menu items on delivery there is?
So it is very practical, and we don't have standard pricing pan-India. It all depends on your order demands, in some cases, percentage of discounting. So various factors, menu mix, what sells more in which outlet. So we are very, very dynamic about that.
Yeah. That is helpful. Thanks all. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Ashish Kanodia from Ambit Capital. Please go ahead.
So, Rahul, on the delivery business, while we understand that as dine-in recovers, there will be some decline in delivery. But within the quarter, have you seen the delivery revenue momentum kind of declining on a month-on-month basis, or do you believe the current run rate, right, with the current run rate to be more sustainable?
No, we have not seen that. So if you look at our monthly delivery business, the first 4 months, which was also the period of strict dine-in lockdown and in general countrywide lockdown, our delivery business has spiked significantly. And post the first 4 months, the business has been pretty stable. In fact, towards the end of last quarter, we also started to see some spike in that business. So I think what we have achieved in our delivery business is a very stable number now, in addition to the recovery in the dining segment.
Sure. Secondly, in terms of gross margin, so you talked about price hikes, but was there some element? So when we look at gross margin improvement both YoY and sequentially, was it also partially driven through higher share of dining? And secondly, as we enter into 4Q, RM inflation seems to remain at a higher level. So do you see any risk to gross margin, or do you believe the price hikes which have been taken is adequate enough to kind of mitigate the risk of RM inflation?
So I don't think we need to take any more price hike in our business now. I think whatever inflation pricing we need to take, we have taken. And this obviously comes with a caveat that there should not be any more significant hikes in raw material. In fact, in some cases, we're also seeing some marginal dip. Some of the global supply chain or things that we import from outside, those have started to marginally ease up, and we're also building up our inventories for that. So I don't expect more price hike. Regarding your question on delivery versus dine-in mix, and because of that gross margin improving, I think the mix between last year versus this year has been pretty much stable. So that has not impacted our gross margin. But what has happened is that as delivery business is maturing, we have also becoming more efficient in our food cost in delivery business. So to that extent, the delivery business in quarter 3 last year versus quarter 3 now, there is a reduction in the food cost. So that has impacted positively for us.
Sure. Just last bookkeeping question before I go on to the queue. What was the operating cash flows which we have generated during the quarter? And I assume that there is no debt on the balance sheet. So is that understanding correct? And also, if you can share what is the net cash balance at the end of 3Q?
So operating cash is around 45 crores for the quarter. Our cash balance is approximately 115 crores. And we have some debt. We didn't retire entire debt. We have around 23 crores of working capital debt. So net cash would be approximately 90 to 95 crores.
Sure, that's very helpful. Thank you.
Thank you. The next question is from the line of Pratik Podar from Nippon India Mutual Fund. Please go ahead.
Hey, hi, Rahul. Just curious, you've added extension kitchens this quarter, and then you made a comment that you're not seeing month-on-month decline in sales of delivery, but on a per extension counter you would have, right? Is that a fair understanding?
Yes, if you add extension kitchen to the overall count, then you will see marginal. But overall extension kitchen that we had on average in the entire quarter was 10 out of total restaurant network of say 170. So yeah, to the extent 4-5% you would say there will be decline on a per average basis.
Okay. And quickly, just wanted to check, you have this delivery business in the last 6-9 months, you would have gained some insight. Can you just talk about what's the occasion? Why does a person order from barbecue? Order barbecue as a box?
So it is again a group eating product. So if there is a family of 4, one barbecue in a box product is good for them, and that drives typically the weekday demand. In case of some office get-togethers, we are seeing boxes orders of say in a range of between 2 to 5. Weekends, if there's any get-together, then again people are ordering between 2 to 3 boxes, and it's working very well for house parties. In fact, towards the end of the quarter, when the New Year season was there, last week was extremely good in terms of box orders. So that is what is driving the box demand.
But the demand is still celebration, right?
Yes, it is. Same box is celebration. A la carte is typically individual consumption.
Okay, got it. And just also wanted to check with you if you can give a split between box and a la carte. Is it possible, or you would not like to display?
Would not like to give that.
Got it. Thanks. I'll come back in the question. Thank you.
Thank you. The next question is from the line of Manish Podar from Nippon India AIF. Please go ahead.
Yeah, I just wanted to get your thoughts now. Let's say for store opening, how are you seeing the environment? Anything on rentals? Do you want to press the pedal and probably increase the store count addition for next year, given how, let's say, the COVID was in third wave?
Yes, actually we already done that. So if you look at our store counts, we have added 2 in quarter 1, 2 in quarter 2, and then now 7 in quarter 3. And in this quarter, January we already added 3. February we are expecting to add around 4. March again around 4 to 5. So on a quarterly basis, this quarter I think we should do around 10 to 12. And some may slip to first week of April, but the construction pipeline is very strong. And so we are seeing that our timeline from the site coming inside the system to commercial launch is pretty long, which is around 4 to 5 months. So after quarter 2, when the COVID-related things went out, we have been building up our pipeline very strongly. And in the commercial rental, the kind of sites that we look at, which is not prime real estate, prime high street, high rental sites, we are seeing a good attraction, and I think the market rentals that we are getting is justified, and to that extent we are also speeding up our store opening.
Okay, just one more out. So, any idea, let's say, the terms which we now get for delivery, how would that stack up with, let's say, larger QSR players? Or would it be similar?
Difficult to say. I am not privy to the exact terms of that, but I would tend to believe that they're similar.
Let's say in terms of both variables, the data and let's say the take rate.
No, I won't be able to comment on that.
Okay, fair enough. Thank you so much.
Thank you.
Thank you. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening, Rahul, and congrats on excellent numbers. I just had 2 or 3 questions. On the margin side, this quarter you've done a 15.4, and this is in spite of the fact that, the early part of the quarter was still a bit, kind of half in terms of the way openings happened. I just wanted to get your sense on in a quarter where, you're not full throttle and you still achieve such margins. Does that provide you greater visibility into fiscal year 23, which will probably be given the current situation, be literally a normal quarter? So is that something that we build, like a 15% plus kind of a number for FY23, or you think there are headwinds to that given the mix on delivery or even the inflation?
So I think we should be able to do that, and I'm positive, more positive now than I was earlier.
Right.
If you look at broad components, I think on gross margin, I'm not so worried. There are measures being taken to work on your food costs, and that will tend to give you results. On the employee cost, we are pretty sorted, and we're also seeing good whatever work we have done over last 1.5 years during the COVID times has shown results in this quarter. And other costs are pretty much also in check. In fact, what I'm slightly optimistic about, and obviously time will tell that, is further improvement in our dine-in business. If you look at this quarter also, towards the fag end of December, we started to see some restrictions coming, and that also matched with the celebration, right? So most of the restaurant industry makes good amount of business during the last week of the year, right? And that helps, and that we started to saw slightly declining, both from the customer sentiment perspective, which is they don't want to go out, and also from some restrictions they started coming in places like Bombay and Delhi and key markets. So to that extent, I think there is some upside also, hopefully should come in our dine-in business. And also during the quarter, while there were some talks of corporate coming back, when the Omicron wave started hitting the world, most of the large corporates again retracted back from opening up full throttle. So once that comes back and corporate comes back, there should also be an upside on the top line, and a mix of those two should help us to meet that 15% plus EBITDA margin benchmark.
No, that's great to hear. The second question is on Toscano. So I missed the first 5 minutes. I'm not sure if you answered this already, but the investment of 17 odd crore, is that a signal that you're going to go a bit quicker in terms of expansions there? And secondly, the implied valuation of that investment is higher than probably what's in your book currently for the company. So does that mean that you need to kind of upward revise that number? Is there an accounting impact of that we expect going forward?
No. So one, the investment is done at a post money value of around 88 crores. So I think what is confusing is the fact that our shareholding moved up from around 61 to 68 by putting in 17 crores, but there's also dilution, right? We are only doing primary investment here. So the 61 also is diluted to a lower number. So that's why the valuation is not higher than what we did in the first round. It's in fact slightly lower than what we did in the first round. We are a strong believer in this business, and we are also wanting to consolidate our position in this and invest for the growth. But before this quarter, we had around 10 restaurants in Toscano. We added 1 in this quarter, and we have 2 more under construction today. And over the period of next 2 years, we're expecting to take this from, say, 13 outlets to anywhere between 20 to 25. And again, it's about opening up markets. We have opened up, apart from Bangalore, Chennai, Pune. We want to also do inroads into Bombay, hopefully in the next financial year. So to that extent, yes, we want to accelerate our position in Toscano.
So just a last follow-up on that. Would it be fair to say that you're probably more confident that you were about Toscano even when this business was bought into Barbeque Nation a few years back? So the confidence level has only gone up given the way the outlets have performed in the existing cities.
So we are always confident, frankly, Harit. And it's just about timing. Toscano was a very concentrated business in Bangalore, right? Yeah. And because of restrictions, and just small P&L, right, as compared to Barbeque Nation. So the COVID would hit a smaller P&L more than what it would hit, say, Barbeque Nation, which also went ahead and raised capital, and protected itself. So to that extent, I think we were very cautious, and once the business has performed pretty well over the last 3-4 quarters. And it's also about opportunities, right? Toscano is a business which opens up sight in more prime real estate than what Barbeque Nation does, right? You'll find Toscano in UV City in Bangalore or in a mall. So there, unless rentals make sense, we would not do that. And in some of the cases, we believe that now rentals are making sense. So we are going ahead with those sites.
Great. That's it from me. Wish you all the best. Thanks.
Thank you.
Thank you. Before we take the next question, a reminder to the participants, please to ask a question, please press star and 1 on your touchtone telephone. The next question is a follow-up from the line of Pratik Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, Rahul, just one question. When do you see the gap between restaurant operating margins and company margins coming down a bit? Can you throw some light over it?
So we are already down to around 5.3% in this quarter.
Right.
I think somewhere 5% is pretty achievable, and we will try to achieve that in any of the quarters in this financial year. But below 5, we'll have to see. Because at the same time we also keep investing in our backend capability, right? So I'll not give guidance lower than 5 currently, unless our top line goes up significantly more than that.
Perfect. Thanks.
But we've already done, right? We were, if you remember, last year we were at 6, and now we're already 5.3. So some advantage we're already seeing in our business.
Got it. No, I think your restaurant operating margins.
You are speaking with.
Hello. Yeah. No, your restaurant operating margins will also move up, right? Because this quarter it's not a normalized one because some of your stores were not fully operational, right? Which is what you have highlighted in your presentation. They were partly operational. So to that extent, I understand what you're trying to say.
Right. Also, the maturity profile of new stores. So that is something that you should keep in. Yeah.
Got it. Thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Dhruv Daria from Motilal Oswal. Please go ahead. So Dhruv, your line is in talk mode. Please go ahead with your question.
Hi, can you hear me?
Yes,
please clear now.
Yeah. So first question is regarding employee expenses. If you can just elaborate what all initiatives have you taken to variabilize this cost? That's first.
So a few things here. One, if you remember, we already spoken that during COVID times we have tried to reduce the number of manpower in the outlet by approximately 10%. More with respect to work role responsibility study. So that has attributed to lower mandate growth versus the top line growth. So that has reduced the percentage number on manpower. Also the mix of manpower, right? So in our outlets we have the entry level staff and goes up to the business manager, which is the restaurant head. So there are 5 levels in that, and we have tried to work on an appropriate mix and also fixed up outlets where the mix was not in the correct picture. So more of technical efforts going. We have not tried to keep them off roles. We are a very restaurant experience driven brand. So just moving them off roles and keeping them as totally variable pay doesn't work for us. As of now, while we are still evaluating some of these studies, but what has led to effort is more of the other tightly control and operating metrics measurement rather than moving them off road and making them totally variable.
Okay, thank you. And just one bookkeeping question. So do these lease concessions, which are included in the other income, do we expect them to go down going ahead, considering that now the COVID situation has somewhat normalized, or do you still have these negotiations going on with your landlords?
No, it has significantly went down. So if you look at this quarter, we only have around 45 million as operating income, out of which some part is also interest income that has come from our FDs and all that we have, right? So it has significantly come down in quarter 3 given stabilization. The results that you are seeing now is pretty much normalized results. So obviously quarter 4 is impacted again. In the month of January we had shutdowns, like you mentioned, from complete shutdown in Delhi to weekend curfews in Bangalore and night curfews and those stuff. So to that extent, we are in discussions with our partners to see if we can make it variable, or to the extent of the time that we lost the business. But going forward, I'm not expecting this to significantly add to our other income.
Okay. Last one question. If you can share, what is your rental agreements like? I mean, is it fully variabilized? I mean, is it fully fixed, or to what extent is it variabilized?
So this is very very flexible. So we have fully fixed contracts also. We have very few contracts which are also fully variable cost, and some contracts have both minimum guarantee and some revenue share. But large part of our portfolio would be fixed rental model.
Okay. Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Ashish Kanodia from Ambit Capital. Please go ahead.
Rahul, just 2 questions. One, I think you talked about your store aspirations for Toscano. In terms of barbecue, what is the number of stores which you are looking to open next year? And second, in terms of extension kitchen, I understand it might still be at a very nascent stage. But is there a pipeline or a thought process that the number of extension kitchen which we want to open in the next 1 or 2 years?
So overall, in terms of total restaurant count, we want to add between 35 to 40 stores every year over the period of next 3 years, and try and take the count to around 300 by FY25. So that's on the overall count, and the mix between Toscano and Barbeque Nation would be very opportunistic driven decision. If we get good sites in Toscano, I will not shy away from doing say 2-3 sites in a quarter also. And if we don't get good sites, then I'll not do maybe not even a single site in a quarter, right? On the extension kitchen, we already have around 12 now. Another 4 or 5 we plan to add this quarter. And then we want to see, it's very young, like you said, very nascent right now, not even more than 7-8 months. So I need to comment on that, but after looking at a portfolio of say 15-16, analyzing it, looking at a few cuts, then we will try and see whether we want to take it ahead or not. Or how do you want to take it ahead?
Sure. And this 35 to 40 stores and the roadmap with 300, does this also include any store expansion in international market, or do you believe that there's no plan to open stores in the international market?
Yeah, so I think it will include. We are very happy with our performance in the international market. In fact, quarter 3, we have done more than 20% EBITDA margin at corporate level in international market. And on a top line basis also, on the same store basis, they have delivered SSSGs of upwards of 35%. So now it is generating adequate cash, and we are accumulating that in that market, and we would try to invest that there. But in terms of proportion, out of say 30, 35, 40, we won't do more than maybe 1 or 2 in the international market, right? It won't be that. So it will be less than, I would say, 5% of expansion in that market.
Okay, just on the international market, right? Because we did not have a great history when we were expanding. So just want to understand a bit deeper here that first, what's the thought process in terms of incremental cash deployment? So when you think about opening 1 or 2 stores, will it be only restricted from the funds which your existing stores in the international markets are kind of generating, or if there is an opportunity maybe, in terms of good sites and all, and if there is a need, you would invest in those international markets from India as well?
Yeah. So, look, yes, we had a bad experience with international market almost 2.5 years back. And like we have always said, we have worked towards improving our performance, and we have now consistently delivered, more than double-digit EBITDA margins over last, 5 to 6 quarters. So I think our business in international market is very positive, and we're very disciplined despite the performance to not take up any side there. There's definitely very selective opportunity that will come, and the payback periods in some of these are pretty similar to what we see in India, right? So the decision making lens is only from the fact that that is the payback period justified, and is it similar to what you see in India? And if the answer is yes, we want to go back. So that is one part of the international strategy. The second part also is over a period of time, and if your bandwidth permits, you will see how do you expand your international markets into a low-cost model, franchising model, or any other model, right? Today, I think our hands are full with expansion in India, but selectively we would also add 1 or 2 in that market. Will it become say more than double-digit percentage of our total? I don't see that happening in the near future.
Sure. And just last bit on both employee cost and other expenses. You talked about that there is a reduction in, I think, 10% in terms of headcounts. But now when I look at the monthly run rate of both employee cost as well as other expenses, so employee cost this quarter was close to 56 crores. Last quarter, a quarter before that, it was around 46 crores. So and when we look at FY20 full year numbers, right, the total employee cost was around 200 crores. While when you look at the overall store expansion, I think the overall store has gone up by maybe around 5 or 6%. So was there any one-off both in employee cost and other expenses? Because again, other expenses this quarter is 67 crore. Our previous quarter it was around 57 crore, and when you look at the full year number for FY20, right, it was around 190 odd crore or so. So is there any one-off which we are missing here?
No, so sorry, I should have thrown a lot of numbers at me. But no, there are no one-off numbers. But on the employee cost, the headcount is pretty much in line with our expansion. What has happened is, as the business has also grown, we might have added maybe a few more employees in some of these stores. Also, we had opened 14 restaurants this year and 13 under construction, right? So typically, manpower comes in anywhere between 30 to 45 days before the store launch, right? So that they also get the adequate amount of training. So some of the under construction pipeline manpower is also added. So it's not just fair to just add the number of stores which are operational. Also, in our employee cost, we pay approximately 4% service charge to our employees, so that they feel part of the growth story of the company. And as the sales grow, some number grows over there, right? So despite that, you will see that as a percentage number, it is lower. But just to answer, no, there's no one-off employee cost or occupancy cost numbers that we're seeing here.
Sure. And just lastly, again on the store economic side, right? Now you have a base of a couple of stores who have been delivering for last 1.5 years now. So when you look at some of the stores who have been delivering for last 1.5 years, and then maybe in 3Q, those stores reached back to your in terms of dining, they were already back to 100% of pre-COVID levels. When you look at some of those cohorts of stores, how is the EBITDA margin moving versus pre-COVID level? I mean, I'm just trying to understand, because when you look at the stores which are fully operational, you talked about, I think the PPT says 21.5% EBITDA margin, right? So just from a store's perspective, that is for the stores which are already matured enough and have a good track record of delivery, are the margins back to pre-COVID levels? Are they better than pre-COVID levels, or what it is?
So they're back to pre-COVID levels. If you look at blended margins on a standalone India basis, we are pretty much similar at around 21-22%, right? And that's what we have done currently on a fully operational stores. So the margins are pretty much back in a quarter when we had full operations, right? There might be some pressure in margins when in quarter four because of the impact of Omicron third wave in January, right? But yes, the margins are pretty much back in this quarter. And in fact, also if you look at our vintage analysis, pretty much all the vintage numbers are also on track. The only caveat there is few of the older stores which are based in IT Park hub areas, they're not back to the same level.
Okay, got it. That's very helpful. Thank you so much.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Kapil Agrawal from ITIS Capital. Please go ahead.
Hi, I have only one question. So when I look at the advertising as a percentage of sales, Barbeque Nation tends to spend relatively less despite having a smaller top line than established QSR chains. So what is the thought process behind this move? And if you're looking to scale to newer cities and penetrate more into the population, doesn't this serve as a little bit of a competitive disadvantage? So could you give some clarity on this, please?
Yeah. So thank you, Kapil. Look, the Barbeque Nation brand has always relied on word of mouth advertising than ATL or BTL marketing. Over the last 15 years, if you look at our data, we have not spent more than say 1 or 1.5 percentage point of top line on this. We believe in investing back in our consumers and our guests. We believe in giving them a great experience at the outlet and invest some money in that. And we believe that once our guests are happy, they will go back and talk about it, and the business will naturally happen. And we have very good metrics called guest satisfaction index, where we call back 20% of guests every day and take the feedback. And I'm happy to say that quarter 3, our guest satisfaction index numbers were the best COVID environment. So consciously we don't want to and don't need to also invest in advertising. Having said that, as the P&L is now growing larger, obviously some of the benefits of now advertising can help us, and that would help us more on low demand days, which is weekdays, say Monday or Tuesday or Thursdays, and very tactically we are spending money on that, and we don't need to, I think, do more than that as of now.
Understood. Thank you.
Thank you, Kapil.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal AMC. Please go ahead.
Hi, Rahul. Congratulations on a great set of numbers. Rahul, the full off restaurant.
Mr. Patodia, your voice is breaking up, so if you can speak closer to the answer, please.
Hello. So the full ops data that you've given on average quarterly revenue per outlet at 1.7 crores. Is this what you would expect to be the full throttle, or you think there is some seasonality? So should we think about a full ops restaurant of barbecue generating 7 crores of sales a year?
Yeah, it should. And typically in quarter three we have seasonality. But in this quarter,
you would have lost a few days also, right?
Yes, that's what I'm saying. So in this quarter, we had lost actually few prime days towards the fag end of December, and also this quarter we have not seen the corporates coming. It used to happen pre-COVID, right? So with both the impact, I think I tend to believe that the seasonality impact is not there in quarter 3, which we typically see in a pre-COVID environment.
Got it. Okay. So just if I were to think about FY25, where you have said 300 restaurants. So the potential of that 300 restaurants could be 2,000 to 2,100 crores of sales, because this includes delivery, right? So,
yes, this includes delivery. Yeah.
So, okay. And some somebody had asked this question earlier, the gap between restaurant margin and corporate margin, will that fall at a similar pace of 50, 60 basis points for every additional, let's say, 100 crores of revenue? Or do you think it stops?
No, I think 50-60 will be a bit more optimistic. I think as we grow larger, there may be some other management costs that might come in. So I would model not more than not less than, I would say, 5%. I think that's a very comfortable number. And while we obviously strive to bring it down to around 4.5, but as of now, I think 5% number is a decent number.
And what last question, Rahul, what is the net cash position now at the end of 9 months?
So we have cash of around 150 odd crores, and we have some debt of around 23 odd crores. So net cash would be around 91, 92.
This is after the Red Apple, that Toscano stake increase?
No, Toscano stake increase will happen this quarter.
This quarter. Okay, so I need to deduct that for about 12 crores from that.
Yeah, but that money also is going for expansion and will be part of subsidiary, right?
Okay. Yeah. Fair enough. Okay, great. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Samir Gupta from IIFL. Please go ahead.
Hi, sir, and thanks for taking my question. Just joined a little late, so apologies if this is asked before. So dine-in recovery at 108% level, can I also know what it would be at a per store level? So basically just dividing the per number of stores in the base.
Yeah, so at per store level, we are at par with what we did in the same quarter of FY20.
Okay, so there's no growth.
Yeah, so it is, when I said par, yes.
Okay, thanks. That's it from me. Thanks, sir.
Thank you.
Thank you. The next question is from the line of Sher Singh Yadav from Moneylife. Please go ahead.
Good evening, sir. Sir, I just wanted to ask about the status of these corporate clients. Are they coming back, and to what extent?
No, initial part of the quarter, we were hearing news of some large corporates coming back, but towards the end of November, early December, with the news of Omicron spreading around the world, we again some of these plans of these large corporates have been postponed, and we still don't see large corporates around in our restaurants as much as we used to see pre-COVID.
Mm-hmm. And sir, what is the margin right now for the extended kitchens? You had given a target of around 15 to 16%. So what do you think? Where is the margin right now?
So very young business and it's evolving, but it is pretty much at the same status as last quarter. We also said that as we will work on our top line growth in extension kitchens, and then it will these margins will come in. And this is very new, around less than 6-7 months old. So we should wait and see how this evolves. And also very small portion of our overall business too, right?
Okay, sir. And what about the status of Toscano extended kitchens? They were about to be open.
Sorry, they were about to? I missed the last part.
They were about to be open, no? You said that in the last phone call, I think. Toscano extended kitchen, sir.
So we added one Toscano extended kitchen this quarter.
Okay. Thank you, sir.
Thank you.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments. Over to you, sir.
So thank you all for joining. We had a record sales and profit quarter this time, and we'll strive to achieve better numbers as we move ahead and as the impact of subsequent waves also subsides. We are hopeful of the large India opportunity that we see, and we'll look forward to interacting with you more in subsequent quarters. Thank you very much. Thank you, Ashish and Ambit team, for organizing this.
Thank you.
Thank you.
Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.